Hello and welcome to this IBSA podcast about this Wednesday's spring budget in the UK. A rabbit may not have actually been pulled out of the bag, but there were some interesting aspects, particularly regarding the infamous non-doms of the UK. My name is Roy Saunders, founder and chairman of the IBSA, the International Business Structuring Association, which is a multidisciplinary global association of entrepreneurs and their professional advisors dedicated to sharing their expertise with each other within a great networking platform. Today, I'm joined by Joe Johnson, a director of Evelyn Partners working on international tax issues. So, Joe, perhaps you could give me an overview of the changes, perhaps what's happened for individuals, what's changed as regards trusts, and what's changed to the IHT regime.
Thank you, Roy, and it's a pleasure to be with you and your listeners here today. So, in short, a lot has changed in principle, and as you say, those changes affect non-dom individuals differently to trustees. So perhaps we take each in turn, but fundamentally, the proposals, as mooted by Jeremy Hunt in his budget, are that the non-dom regime will, for all intents and purposes, end with effect from the 6th of April 2025. There's a big question mark there, clearly, as to who will be in government as at that date, but let's assume that the rules remain as they are. So before we get into the changes, it might be worth just quickly highlighting what the rules are today for the sake of comparison. The rules as they work today are for UK resident but non-UK domiciled individuals, non-doms, so people born outside the UK. They have the ability to claim the remittance basis of taxation up to a period of 15 years. And very simply, what that means is, subject to making an appropriate claim, they are not subject to tax on their foreign income and capital gains, i.e. stuff earned outside the UK, unless they remit it to the UK. And then from that 15 years of residence, they also become subject to inheritance tax on a worldwide basis, much the same as any Brit. From the 6th of April 25, that regime will fall away and will be replaced with a residency-based test, whereby new arrivers are able to effectively exempt foreign income and gains, but only for a period of 4 years. So in that 4-year period, their foreign income and gains aren't subject to UK tax. A big difference being they can then freely remit those sums to the UK without any tax. But then after that 4-year period, they don't have the ability to claim that beneficial regime. And that is predicated on individuals having had a period of non-residence for at least 10 years prior to that date. Any remarks?
No, I'm listening carefully because I think that 4-year period is quite a short period, particularly for budding entrepreneurs who perhaps are building their businesses and who won't realise any income or gains in that 4-year period.
It's a really good point, Roy, and it's sort of the detail of the proposals aside, it's worth reflecting on why did that period come to be? How does it stack up versus international peers, etc.? Just listing off a few other developed nations and their regimes that were ironically built upon ours. Israel has a 10-year inbound regime, Italy 15, Portugal 10, Spain 5. We were all expecting within the profession that the Conservatives would likely do an Italian job, as it was colloquially known. So a 10 or 15-year regime with a fee to access of an amount, say up to £100,000 or £150,000 per year. So a 4-year regime with no corresponding fee is quite a large deviation.
I had thought that it would be 7 years actually, and the fact that there's no fees attached to it might be interesting. And of course, for high net worth or people who have got a lot of money, that could be valuable. But it's only for 4 years, so yes, it is a surprise, I think.
But I think just to answer your question, it's a very attractive regime for that 4 years. The question is, if you were coming to the UK for the first time, would it be attractive if perhaps you might make money in years 5 onwards? Who knows?
The interesting thing about the budget, before we get on to the trusts side, which I'm very interested in, is that the individuals who are here, who are non-doms already,
Mm.
can remit the income that they've left offshore in 2025-6 and 2026-7 for a 12% tax charge. I think that's a really interesting, politically correct idea, because it will bring a huge amount of money back into the UK, subject to 12%. So there's going to be a tax benefit, but there's also going to be a lot of money in the UK now coming from those. And I don't know how much that's been and whether or not you know sort of the volume that that's likely to be, but it seems quite attractive.
I totally agree. It's a really interesting point. And whilst we're focused, we were previously focused on people coming here for the first time, you're quite right. There's a whole population of non-doms that would have been here for between 4 and 15 years and 15 years onwards, who would have expected to be able to claim the remittance spaces that are affected. And there are some transitional reliefs, including the one that you mentioned for that population of people. I think it is attractive because, look, if you're a deemed domiciled individual with a lot of foreign income and gains effectively locked up offshore, this is a great sort of one-off amnesty whereby
I
you
was going
say
to say it's an amnesty, isn't it?
it
It
is.
I haven't mentioned the word amnesty, but I think it is. It's like the Italian amnesty that took place, which was extremely successful and brought a huge amount of wealth back into Italy.
And it is attractive because one would assume that for those population of people that have been here for a long time, they've likely already remitted their clean capital, so sums that can be brought to the UK without tax already. So what remains is foreign income and gains that would otherwise attract a tax charge. And if they're foreign capital gains, then the minimum is 20%. If there's foreign income, 45%. And practically, some people, it's so hard to even untangle what those amounts are that have accrued over many years. So it's not only is it an attractive tax rate to get money into the UK, they actually save a lot of brain ache by just accepting a palatable 12% charge to inward invest. So as a foreign direct investment policy, I think it's a great way to get a real cash injection into UK PLC.
Okay, no, I think that's right. What's changed as regards trusts, and particularly protective trusts, the ones that have been created by non-doms prior to becoming domiciled?
Yes, that's a very good question, Roy. And perhaps we take it in two parts because there's the income and gains position for assets held in such vehicles, and then there's the inheritance tax position, which we await further detail on and it is subject to consultation. So tax aside, clearly people set up trust for a whole host of reasons. But if we focus on the tax, it's standard practice for individuals approaching the date they become deemed domiciled, so 15 years of residence, to consider setting up excluded property trust. Why? Because effectively it grandfathers the benefits of the remittance spaces. So unless value is extracted out of such vehicles, income and gains can roll up tax-free, or foreign income to be precise, and all capital gains can roll up tax-free until value is extracted, and non-UK citus assets remain excluded from inheritance tax. So very sort of attractive vehicles to grandfather the benefits of the remittance spaces. What the proposals say is, as we're reading them, is as long as there are either existing trusts or newly created trusts that are set up prior to 6th of April 2025, then from an inheritance tax perspective, at least, that status will remain. So non-UK assets will remain outside the scope of inheritance tax. So there's going to be a big push for clients before the 6th of April 25 to consider setting up such vehicles. From an income and gains perspective, that's an interesting one. There will be a fundamental sea change in the way that these vehicles work going forwards. Very broadly, any income and gains that accrued within such structures prior to April 25 will remain outside the scope of UK tax, potentially indefinitely, and will be assessed with reference to sort of distributions received from the trust. So it remains an effective roll-up vehicle. However, income gains arising after that date for settlor interested trusts, so for trusts where the settlor retains or close family retain an interest, those income gains will be assessed on the settlor. In the first 4 years, for individuals able to access the new foreign income and gain sort of residence-based test that we talked about a moment ago, those income and gains will be tax-free. But after that period, the individual will be assessed personally. So the trust sort of ceases to be an effective roll-up vehicle from an income and
If the
capital perspective.
settlor, yeah, if the settlor and his wife are not beneficiaries and cannot benefit from the trust, then the transfer of assets abroad regime, if you like, isn't applicable for them. So those trusts, those protective trusts, would still be able to earn income and gains after that period.
Yes, so that's an interesting point you make. So for existing trust structures whereby the settlor is excluded, or the settlor has deceased, or the settlor is non-resident, then you're absolutely right. There might be a different category of trust that get sort of more favourable and old school street treatment, if you like. It's
Yeah.
worth noting that for the capital gains tax, at least, a trust will remain settlor interested unless you exclude all the way down to grandchildren. So there's different rules for income tax, CGT, and inheritance tax. So the devil is in the detail. But you are right in principle that there are definitely opportunities to look at the exact drafting of such vehicles.
So practically, what would you be recommending to clients now? And I'm sure you've had quite a few clients who've been on the phone to you asking what to do. We've got plenty of time to do it, which is quite, I'm not saying it's surprising, because, we're near to the 5th of April 2024. So I wouldn't have been that surprised if they'd have introduced all of these changes as of that date, but probably practically they were unable to do so. So there is time to do this planning. What would you suggest people do now?
Yeah, that's a great question. Thanks, Roy. So I think it depends what camp you sit in. So whether you're a new arrival or someone potentially considering coming to the UK versus someone who would have expected to get the remittance basis but doesn't benefit from the new regime from the 6th of April 25 versus someone who's been here more than 15 years. But I think all you can do is sort of understand the potential implication of these rules. And the reason I say potential is because, as we said earlier, if Labour are successful at the next general election, then they have every right to tinker with these rules at their first budget. I would consider, whether a trust made sense prior to April 25 for clients who may want to benefit from such structures from an inheritance tax perspective. For existing non-doms, you mentioned it earlier, I would be considering the transitional reliefs. So the big E being the 12% rate for all foreign income and gains for the 2-year period to 2027. So I'd be looking at what I've got, how much I need practically in the UK, and really think long and hard about if I'm going to remain here for the long term. That's a great one-off opportunity to get money into the UK. There's another transitional relief for people on the old remittance basis, whereby only 50% of foreign income in 25-26 is subject to tax. So you might say an effective 22.5% rate. I would be thinking, is there anything I can do to control that? Accelerate dividends from closely held companies, etc., offshore. Then there is the rebasing. That's an interesting point, and the point there is for people that have claimed the remittance basis in the past, they will have the ability to rebase personally held capital assets, as long as they were personally held as at April 2019 to the April 2019 value. The interesting point is, well, why 2019? And we're all speculating on that point. I can only imagine that's because pre-COVID markets were at their highest, but I am guessing. So there's an exercise to go to sort of work with bankers, etc., to ascertain and take permanent note of those asset values. And then for clients who are beneficiaries, settlors of existing trust structures, I would be working with my trustees to sort of draw a line in the sand as to what the income and gains pools are as at April 25. So what's happened historically, so that I can understand the implication of future distribution. So there's a bit of an accounting exercise to be done for some clients. For other clients, there's a real decision point around: am I going to remain in the UK? Do I see myself leaving? What might I need for cash flow purposes? And to consider benefiting from these transitional reliefs?
Well, from a political point of view, I mean, you mentioned if Labour get back in, which they may well do. I'm not sure that they would tinker that much with these rules, and I think this was quite a good preemptive strike, if you like. Do you think the Conservatives have done enough to garner support for them? To some extent, they have reduced inflation. They've done what they were saying. So, do you think they've done enough with this budget to change the tide?
In short, no. I don't think so, because I think, for the common electorate, okay, the non-dom issue has been in the press, and it's a controversial point, but whether or not Joe Bloggs will understand it, or care to be interested in the exact detail of these rules, who knows?
Do you think there were other things in there? I mean, yeah, the national insurance reduction of 2%, but that might have been countered by what they call the stealth tax, which is, the freezing of limits for income tax purposes. So, one might have countered the other if, with inflation being relatively still strong, then they might not have gained that much from the 2% cut. So I don't know. What do you feel about that?
I think it was overall a positive budget in the spirit of fairness. Obviously, there was the announcements to abolish multiple dwellings relief for stamp
Well,
duty, land tax purposes, and
yeah, that was
obviously
hilarious, that
it
announcement.
was hilarious. I saw Angela Rayner was quite exercised by the exchange in
Absolutely,
the
yeah.
comments on that one. But and the sort of the abolishment of the furnished holiday let regime. So a couple of policies there aimed at second home ownership fundamentally, which, if you're thinking about fairness, and then that can only be seen as a positive step. There was no real subject to this new residence-based concept of assessing IHT for non-doms. There were no sweeping announcements on inheritance tax, given not so long ago people were questioning whether Jeremy Hunt might consider scrapping inheritance tax altogether. So that was a bit of a U-turn, and that might have perhaps garnered more support from pensioners, etc. But clearly they have to balance the books.
Okay, well, I mean, that's really interesting. I think it's been fascinating. I know we've concentrated a lot on non-doms, but that's probably one of the things that have been most I don't know, thought that it would happen, I suppose. So it was quite good that we've concentrated on that. And there is a lot, as you said, in the detail that we still have to consider before really practically making any plans for clients. But anyway, thank you, Joe. Thanks for joining me today. It was really interesting. I'm sure our IBSA members will listen carefully to your comments and practical recommendations. I mean, they may have some questions. We're meeting again on the 9th of May at the IBSA annual conference. It's actually our 10th year anniversary, and we're concluding it with a champagne reception and evening barbecue. So I hope to see you there. Details are on our website at theibsa.org. So it remains for me to thank Joe again, and thank you all to our listeners for engaging with this podcast. I hope you've enjoyed it.